Hey guys, welcome back to another episode of Understanding DGOC. Today we're going to go through the financial statements. So we're going to start with the income statement. There's a few things I would like to point out here. First, here you see the revenue from 2018 and 2019. So this is 2018, this is 2019. And this is an increase of about 87%, as we saw in the previous episode of Understanding DGOC. And while that is very good, what you may not expect is what happened to their earnings. And here you see the earnings of 2018, and here you see the earnings of 2019. And what do you see? You see a decline by about 50% in the earnings, while the revenue increased by 87%. So this is one of the reasons why I don't like to just look at an income statement or just look at the basic valuation ratios like price to sales or price to earnings, because they can differ a lot, and what may be in between these lines may be very valuable to understand. And in this case, it is very important to understand several things, and we're going to go through that right now. First, in 2018, right here, you see gain on bargain purchase. This was 173 million. By the way, I sometimes may say million and sometimes I say thousand. 173,000 is just because these numbers are written like in thousands, but they're actually millions. But I might just make a few, how do you say that, spelling or speaking mistakes, I should say. Anyway, here you see the bargain purchase of 173 million. What this is basically when they buy an asset and they buy it for cheaper than what it's worth, then they get to they have some extra value that they didn't pay for it, but that value needs to be visible in their financial statements. And that is basically what you see here. So what has happened here, possibly, let's just give an example. They bought an asset for about 400 million US dollars, and the actual value of the asset was 573 million dollars. So they paid 400 million dollars for something that is worth 573 million dollars. So what needs to happen then is that they get some value added to their income statement. This is in no way cash, and that is something to keep in mind. We'll get to that later, but this is no cash, and this is basically what blew up the price to earnings or the earnings in 2018, and what basically created such a great price to earnings ratio. Because I remember when I was just starting to researching this and it started dropping, at some point the price to earnings was around 2, which is insane. Right now it's trading at about, I think, 7, 8, which is normal. But we're not going to look at price to earnings because this is one of those things that is actually making that measurement not a good measurement. And you see that in 2019 they barely had any gains on bargain purchases. Something else that I would like to point out is the gain on derivative financial instruments. Here's 2019 and here you see 2018. There's a big increase. Why is that? Because the natural gas price has dropped, but they hedged. So how you need to interpret this is, if they have let's say the natural gas price is on average throughout 2019 is $2.30, but they hedged against a price of $2.70. The revenue, let's say it was all completely in gas, that would leave like let's say 200 million production of gas, that would leave them with a price of $2.30 in revenue, but they had an increase, or they had a selling price of $2.70. That difference, 40 cents, is basically what you see here, the gain or loss on derivative financial instruments. So if you want to look at their production growth, or if you want to just see how much value or cash they actually generated from their production, you need to add this number to their revenue. This is not how you calculate gross margin or something, but for you and me, those the non-accountants basically, we want to look at how much value it generated, not how much revenue they have to write down just because those are the accounting principles. So the $462 million dollars in revenue plus the $74 million on gain on derivative financial instruments, combine that will be like 536, I believe. And if you combine that, that is basically how much money their production has generated. So these are basically the two things, so gain loss on derivative financial instruments and gain on bargain purchases, that you want to keep in mind if you are going to go through a financial statement of oil and gas. Next up is the balance sheet, and this is going to be the asset side of the balance sheet. You can also see it as the left side of the balance sheet. So here is everything that they own. So here you see oil and gas properties, so that would be the wells, the fields, and so on. And you see property and equipment. I misspoke just now. The oil and gas properties net is the fields, and the property and equipment is the wells and the other assets like the midstream assets and so on. What is worth noting is that their total non-current assets, which is basically the assets that they they're non-current, like I don't really know how to say anything else like that. It's like there's no way, or it's not that easy to liquidate these assets, like you can only sell it. So what is important here to note is that it has been increasing by $400 million, and this has been increasing mostly through buying assets or fields in this case. So that is something that we're going to use later on. And something else that's worth noting is their cash and cash equivalents and their restricted cash position. As I mentioned in the previous videos, they have a very low cash position, and we know why, because it's basically cost, because you don't get any interest on it, so they try to keep it low and just borrow it if they need it. And you can also see that in their balance sheet. Next up is the liability side of the balance sheet. So there we're going to see all the debt. Keep this cash position in mind, because we're going to use that in a second. So the debt position, this is the liability side of the balance sheet. So we just saw that they had about $3 million in cash, and here you see the non-current liabilities. So these are the liabilities that are not expiring within 1 year, so they don't need to pay this off just yet, but in the future they are going to need to pay this off. So this is the debt basically from 2021 and onwards. So here you see $940 million in debt, an increase of about 200 million. So an increase of 200 million, while their asset has been increasing by 400 million. That's something worth noting. And here at the bottom you see their total current liabilities, and these are the liabilities that they need to pay off this year. So what normal accountants or what normal investors would do, they would check the cash position and they would put it against the current liabilities. And if the cash position is higher than the current liabilities, then the balance sheet is healthy, because the company is able to pay off the debt in the short term. In this case, they have like cash of like, what was it, 3 million, and current liabilities of about 127 million. So that is not enough money to pay off debt. the short-term debt even. So let's say if there's only cash position, and let's say they wouldn't have any production in the future, they would go bankrupt within days. That is how bad it would be. But we are now aware that they are hedging, and because they hedge, they create a consistent cash flow. So we know that for the next 18 months, they are more than happy to pay off this debt, and they will easily be able to do so. So in my opinion, you cannot just look at the balance sheet if you want to check the health of a company. You want to see how much income they have. It's going to be interesting to see that in the future with other companies as well, if they are on the brink of going bankrupt, because are you going to look at their cash position, or are you going to look at how much cash they can generate in that period of time? And finally, we are going to look at the cash flow statement. This is the one that I like the most, because here you see what actually happens to the cash. So how are they spending it? How is it coming in? And is there anything worth noting? It's going to be hard for somebody non-financial to understand this. I'm going to keep it quite simple on this one. There's just a few things that I want to talk about. At the top here, you just see the earnings income. This is just the earnings that we just saw at the income statement. So the bottom line of the income statement is basically the top line at the cash flow statement. All this except for the bottom line, those are all cash corrections. So basically those are things that actually didn't cost cash but were reducing value or increasing value, or the other way around. So if you remember what I said at the income statement, I mentioned the gain on bargain purchase, and that is what I didn't like about it. So let's say they bought an asset for 575 million in 2018. You see that here. Let's say there was 575 million that they bought an asset worth 575 million, but they paid 400 million. In the income statement, you will get this number at a plus, but here you get it as a negative, because if you look at the earnings and you're going to calculate it, you're going to calculate the operating cash flow, you actually realize that, hey, this value that I added on the income statement, this was no cash. This was just the value of a property. So this is not generating me any cash. This is just somebody, let's say an accounting firm, that thinks, okay, this value is actually more expensive or worth more than what you pay for, and therefore you have to put some extra income in your income statement. That is basically what the number is. So it's very subjective, and it could even differ between accounting firms. Like, they have all the same principles that they need to hold onto, but believe me, there can be some difference. So bottom line, this is basically how much cash they have been generating. If you look at their earnings, it's only 99, but you see that the depreciation, where the accountants say, well, you've lost value of about 100 million on your assets, that is what they say. That is not how much cash it costs. You already paid for that property. It was just on your balance sheet. So you need to add that to your earnings to come to see how much cash you actually generated. So bottom line here, after all the cash corrections, this is how much cash they generated, and it differs a lot from the income. Basically triples, more than triple, almost triples the income. So this is what you want to be looking at any company, in my opinion, but especially in this company. So finally, this is still the income statement, but the cash flow statement. But here we have the cash flows from investing activities and the cash flow from financing activities. There's only one thing that I would really like to point out here, and that is the expenditures on oil and gas properties and equipment. That is a cost of $32 million. This is basically their capital expenditures. So this is what they pay to, this is what you deduct from the operational cash flow to generate the free cash flow. This is basically what they need to, let's say, stay afloat or keep on running, keep the business going. And if you deduct that from the operational cash flow, you have the free cash flow, which is basically what the shareholders get in money. How it's distributed, we do not know. That is what the CEO decides, but the free cash flow is the money that the shareholders have generated, or the company have generated for the shareholders. And we've seen in the previous video that DGOC uses it to pay off debt, uses it to pay dividends, and uses it to pay share buybacks, to buy back shares, sorry. So keep that in mind. If you have any questions about the financial statement, doesn't matter which one, income statement, balance sheet, cash flow statement, please let me down in the comments below. I will explain it to you. If you would like to see an in-depth guide on how to read these financial statements, like I've gone over a few things, but I'm pretty sure that you might be interested in all the other stuff that is important. Let me know in the comments below as well. If there is enough people who want me to explain the financial statements, I will make specific guides on that. Keep in mind that it's going to be slow, it's going to be time consuming, so you might be bored out by that as well, but I think you could learn a lot from it. And this is basically what you need to do before you invest in any company, because here you check the cash they generate, the healthiness of the company, all the risks. You can basically, anything you want to know, you can find it here. This should always be your first scan before going any further. Thank you for watching. There's two more series coming up, management analysis and the outlook and thesis. I expect to upload the videos in the next few days, sorry. So stay tuned.